Hi, everybody. Welcome to our webinar on U apartments at Melrose. Today, we're going to be going through a 96 unit property that we're purchasing in Phoenix, in the hot Phoenix. This property is about 3 minutes away from Alcatraz, which is a 161 property that we already own. This offers 506B, so unless if you know us, you should not be investing in this or being solicited to. We do accept a sophisticated and accredited investor. There's about 35 spots for non-accredited investor in here, which we pretty much never use. Basically, this is also a disclaimer. This is an investment. So like any other investment, there's risk to it. So it's a good idea to assess it carefully and take anything that presented in this deck as a financial projection instead of a solid number. So we're gonna go from here now. Okay, so U apartment at Melrose is a 96 unit property. It is located in the Melrose district. Literally, you can kind of see our building right there, right next to this. So we're gonna go through the investment pitch over here, and then hopefully we can wrap it up pretty quickly and maybe have a few Q&As that we have collected from the investors. We'll kind of iterate through that. Before we start the presentation, we'd like to kind of go over some of the things like investor returns so that you know as an investor what you get. You can keep that information in your mind before you go through the whole presentation. So first of all, we're going to do, we are going to structure this deal as our vanilla syndication, what we call. Essentially, there's going to be 3 different classes being offered on this investment. We're going to have a quite big stack on our class A, what we call the preferred equity investor projection. So the minimum investment is 75K. This is a unique class. Essentially, you're receiving an 11% annual fixed rate debt, fixed rate return. So if you are no investors, etc., you know that you're paying a ordinary income tax, and you're probably getting about 8 to 12% of a return on the note market right now. But the take home, let's say someone's a 12% rate of a note investing, the take home is really 8%. If you're paying kind of 39% tax bracket, you'll be taking home about 8 to 9%. So it's all about how much you keep. Whereas this type of investment, it's very much like a note investment. You would be getting an 11% fixed rate return annually. So that's a preferred 11% fixed annual return for the investment. And then if we start doing cash out refi, we will cash out refi your stack first. So this allows you to free up your capital a little bit sooner than the full term, like 2 to 5 years, as it kind of goes. And then you can use that to reinvest into other things. So the benefit of Class A is also, it's a safer class because we're going to be using the cash flow to pay off the Class A first, pay the distribution of Class A first before we distribute to the remaining of the Class B, C, and the general partners. So safer return, lower return compared to others, but safer return, high risk, high return, right? So possible bonus depreciation, not only that, you do get a negative K1 that come along because you are an equity investor and you do not need to return that negative K1 bonus depreciation. It does not recapture until we sold the property. So that's kind of nice. It could be a scenario where all your cash is already cashed out and you're still not having to give back that bonus depreciation until the project is exiting. Now for this project, we do want to hold for long term. So that's kind of nice. And then the B and C classes are traditional equity investor. These are for people who is investing for equity purposes. Here, your money grow a little bit faster. The projection is 13 and 14% for Class B, 13% for Class C. We are doing the 70-30 split for Class C, and Class B is 75-25. So this is a type of investment where we're focused on equity growth. We are structured as a preferred cash on cash return of 7%. Again, I want to emphasize on preferred rate. So if you think about how the deal structure works, is when we receive the cash flow, we're going to pay the Class A as a high priority. That stack leave goes away, and the remainder goes to B and C. So I wanted to kind of really emphasize on B and C is really in this for equity. Therefore, the cash flow may not hit 7% in the first couple of years before we start cashing out Class A. But that being said, the 7% preferred rate just means that we do not pay the general partner share and split before that 7% accumulatively has been satisfied. So don't think of this as, oh, I'm going to get 7% cash flow. It's actually very highly unlikely for our equity investor to get the full amount of 7% the first couple of years of operation due to the big stack on Class A. And then as Class A gets paid out, this is going to get closer and closer. And then what likely mostly happen is at the end, that equity piece, if by that time we haven't caught up all 7%, which will be holding on 5 years, 35% total, then general partner is not taking a dime from that share. So the first 35% needs to be satisfied. Let's say we hold 5 years, that's 7 times 5, 35%, until before the general partner gets paid on that. So that's kind of how we structure it, taking our investor return as a priority. Cool. First of all, we want to meet the team. So I'm Lisa Zen, and I'm the owner and principal for Easy Real Estate at Easy FI University, soon to be, we're renaming our Easy Real Estate to Amplify Equity. So it's all the same. Have over 13 years of experience. I will be the main asset manager on this deal, but it's not just me. We have a team of 15 people, including a few asset managers, accounting, marketing, and customer relations staffs. We're currently having about over 3,000 units in Texas, Arizona, and Washington. We do have track records of being an asset manager on 7 full cycle deals with over 40% IRR on average. I'm going to turn into our partner in crime, Jonathan Lau, to introduce himself, and then Becky and Aaron.
All right, thank you so much for joining and watching this video. I'm Jonathan Lau. I've been in real estate for about 9 years now. It goes by quick. It's been a lot of fun. And in fact, I started partnering with Elisa about 1.5 years ago, and we've done about 1,500 units together. Outside of syndications, I have a portfolio in Washington and as well as Florida. But coming to the table with quite a bit of business experience from strategy, business development, strategic negotiations, contracts, finance, and sales. And so I'm really excited to be partnering on this deal. Thank you.
And my name is Becky Wong Kaplan. I, along with my husband, Dr. Aaron Kaplan, are principals of Lavadu Capital, a real estate private equity firm. I'm a former pharmacist of over 23 years, now doing full-time real estate. My radiologist husband continues to practice part-time as he still loves doing patient care. But as many know, he's heavily involved in real estate as well. Like many others, we began our real estate investment journey in the realm of single-family homes. But since 2017, we have invested in passively and actively in large-scale multifamily apartments, where we have now partnered in over 1,900 units across the country in places like Oregon, Florida, Texas, and Phoenix. We are currently general partners in about 8 deals. Real estate has been really truly a wealth building vehicle for us outside of our prior and current clinical incomes. We love the cash flows it brings, and it's really supplementing our income and placing our current income as well. Additionally, we love that this kind of real estate income with its inherent tax benefits makes it really a significant, more compelling investment for highly taxed couples like us, versus the majority of other investments like stocks and other paper assets. We have partnered with Lisa and her team over many deals and are thrilled to partner with her and other team members in getting this opportunity to our investors in this great MSA of Phoenix, and it's a great, fantastic submarket in the Midtown corridor. Thanks again for coming to this presentation. We're really excited to bring this investment to our investors. Aaron?
Hi, thanks for joining us this evening or during the day, whenever you watch this video. I'm Aaron Renfrew. I've been investing in real estate for the last 25 years. I currently have over 3,000 doors that are in my portfolio. Washington, Arizona, Texas, and Florida. I am excited about the Melrose, and I'm excited about working with this team again. A lot of my portfolio door count is a result of this team and the connections that I've made here. I'm really excited to, as Becky mentioned, extend my tax basis and be able to work from, I get the pleasure of being a real estate professional as a managing broker and also having a property management business. I get to really take advantage of the tax advantages, although they can be good for everybody. Take your CPA's advice on that. But I really like what we're doing here, and I really like the Melrose property. And I look forward to bumping my portfolio that much bigger. So thank you, and feel free to reach out to me if you have any questions as that pertains to you or the property. Thank you.
Perfect. Thank you, team. And then in addition, we have Chris Pinnell. So Chris has been an investor of mine for a very long time, passively investing as well. So we're glad to kind of have him join our team over here. Chris has an extensive technology background and the technology and financial companies and etc. So he's definitely seeing the downside of the stock market and getting his feet wet in the real estate investing, back in the days, and started with passive investing and now participating into our team. Furthermore, we have a whole team in the back over here. We have about 15 employees right now. These are some of our partners, etc. There's us doing some brainstorm sessions over there, done couples of some offsite last year. Since then, our team has grown to a 15 people team. And then we're actually in the middle of moving to self-management in our Houston market. So our Houston properties are all going to be self-managed. And then we're going to be starting doing self-management over here in Phoenix as well. But with team though, so we're actually lucky enough to step into a position where there's a process and people in places already from our Texas team, and all that whole team is moving over, getting merged into our operation. So this is pretty much the best scenario in terms of creating your own property management team, because you're literally just kind of stepping into a system that's already working. So we will be self-managing on this property on Rise Melrose as our effort to continue taking over our Phoenix property to be in the self-managed mode. This allows us to have implement the awesome system that we already created for the team and then replicate it into our PM arm. So to realize the visions that we have to up-level everybody in our community, including our tenants. Cool. So the team, that's our asset management team, currently have over 650 million AUM, about 12 properties, over 5 markets, 7 full cycle deals, and average investors about over 40% IRR. Our property management sample, because we're kind of doing this management, and a lot of that is merging and acquisition. So we'll just kind of show some of the ratios that we've been able to achieve in Phoenix. We have full confidence to be able to achieve the same ratio, if not more efficient, because we currently already control accountings for all our property. And we're, having a heavy hand in Resman, setup, etc. property management software. We kind of effectively already kind of control the back office. So now it's kind of moving the system, also removing some inefficiencies in our management, and essentially percolate that into the system. We typically have charged a 1% fee in the Phoenix market. The property samples that show over here, none of them actually has that except for Amara. For this particular property is a really good age. Amara is an older property. We are going to charge 2% property management fee, but we have dropped our asset management fee only to 1% because we feel like that is the right amount of capital to make sure that the property management company is running smoothly. So again, you're going to be enjoying the 3% total fee between the PM fee and the asset management fee at a lower than the market, essentially. Okay, the markets. Let's kind of talk about the markets a little bit. So current state of the economy, I think There's a big elephant in the room, want to kind of address it. I don't know, Jonathan, do you want to kind of talk about it? We've been to a lot of conference lately and been keeping a tab on our inflation rate. And we've been doing massive amount of research on macroeconomics since the end of last year. We kind of stay on top of this without getting into a little bit too much detail. Inflation rate has hit 8.6% as we speak right now. Feds are kind of meeting each other as we speak right now, so we don't know where the rate's going to go. Stock has been kind of seeing high volatility, including also crypto and then other markets, and possibly more to come. The Fed keeps on hiking interest rate. Why do they do that? Because they want to combat the ever increasing inflation rate, but we're not too sure if they're going to keep that under control. We have a YouTube video kind of talks about that more in detail, but we're in the investment webinar right now, so we don't need to get into that in detail. That increased rate is going to make single family home less affordable really rapidly, because the low interest rate has stimulated that market, which is why bidding war is going on with single family home. But as soon as the rates start increasing in this rapid rate, the economy kind of just slow down in single family home. So we do see single family home market potentially is going to be a lot more volatile than the commercial sector, which even though we are still in the residential sector, but that's a much bigger lion's share, and the Fed has incentive to kind of protect that economy. So the Fed also has public announced to trying to actively shrinking their balance sheet by 95 billion. Put it in layman language, that just means that they're going to take money off the table, off the balance sheet, which also means they're going to somehow find these money and make them disappear, right? So whether it's through crashing the stock market, getting some Bitcoins out of there, or crypto in general, crash the crypto market, or to simply not doing lending, not buying back the notes, and also including, maybe wiping out some housing market to shrinking that balance sheets to $95 billion a month. And then as an effect of all these, 30-year mortgage rate has just rose over 6% as of June 14th, when we recorded this webinar. So that's kind of some turbulence time. And on the other hand, when we're looking at apartment building, it's still the right time to invest in apartments, we believe, because apartment is a cash flow vehicle. If you can get a fixed rate debt on your asset at a sub-inflation rate, that is actually an asset. The debt is actually an asset for you to essentially use that to combat your inflation. So think about it. Your money is burning at an 8.6% rate. If you can secure debt that is less than 8% at a 6% even, let alone these commercial loans are still at a 5% rate. This is really great rate to kind of obtain and then ride the wave for a prolonged period of time. Your arbitrage delta over there is like 2 to 3%. So by just getting the loan, you're actually making 2 to 3%. So this is where we see the opportunity. Nothing other than residential, commercial apartments, for example, is a great vehicle to potentially get a very favorable loan. It's really difficult to get favorable loans on businesses, for example, or mobile home parks and all that sort of stuff. So apartment building continue to be desirable because this is a vehicle that you can get a higher leverage on. Although that being said, getting a lower leverage cash flow deal with fixed rate debt is definitely kind of the formula to hedging against some of the turbulence of economy moving forward. National average of rents are still up 21% year to year March. That didn't really quite slow down any because people need somewhere to live. So the demand is super high, on single family homes. If people are kind of cannot afford their rents and mortgages, then they need somewhere else to live. We specializes in the B and C class investment, which is the need housing. We don't really believe in the want housing because we've seen in last recession as reason as COVID, people are giving 3 months concession in downtown Seattle, for example, on these A-class buildings. So we know that section of class A is more volatile. In our opinion, stay in places where people need housing. If they need a downgrade, they still have a really good value of inventory. A lot of our buildings right next door to the best class A operator, Mark Taylor. This is a fantastic place to be because our rent is consistently $600 below their rents, and with a lot of good value. So it's certainly a affordable option for people who wants to kind of save a buck, who's like a value shopper. So interest rate is going up. Fixed rate market is like really good as interesting going up. Again, the word is still investing in and moving to Texas, Arizona, and Florida, because there's a lot of capital. Capital is agnostic, but still, where can you get a better rate? Majority of the institutional investment was okay with a 2% bond yield. So certainly with this type of investment return, people are still investing in commercial real estate. We do think a single family home may be coming to a little bit more hardship due to that high rate and the less sophisticated market. Not to mention supply is increasing as well. So that supply is going to taper the new build. So if nothing is building new and then people can't afford single family homes, then the only option they left is really to rent place to live. People need some place to live, right? So that's essential needs. That's why we continue to stay in this sector. Here's a example of affordability gap, renting versus owning. Jonathan, you kind of want to go through this?
Sure thing. At the end of the day, the way that I view it is that I think it was Nathan Rothschild, who was a 19th century British financier, who basically said that when the time to buy is when there's blood in the streets, right? And I guess what I'm getting at is there's a lot of uncertainty going on in the market and whatnot. But what's been so amazing is that where there's opportunity here as well. And this graph I think is highlighting it quite well, is that there's going to be a bigger and bigger gap between renting and owning, especially when there's pressure coming from these higher interest rates that people can afford less homes, and so a lot of people might sit on the sidelines and wait things out, and they rent, pushing demand for our asset class that we're choosing to invest in. And so as long as there's a big gap there, where it's not a substitute for our tenant base. And so this is just kind of creating a moat.
Yeah, and then a little bit correction over here. The median house cost around this property is $510,000. So your median mortgage, this is with the 5%, 5% and 4% interest. The interest has raised to 6%. So now all of a sudden the mortgages are more than $3,000, right? If you kind of think about that, compared to our rents performance, going to be $1,650 plus $100 rub, total all in $1,700. This is a lot more affordable than what they can buy for a home. So because people, believe it or not, single family home is a competition for multifamily home. Mobile home park is a competition with mobile home multifamily, right? So you kind of have to look at all these sectors. So the Phoenix market, a little bit update on here, the fundamental has to be strong in order for multifamily to continue thrive in this particular submarket. So when we're looking at this corridor of Phoenix market, based on U-Haul, Arizona still ranked top in terms of the destination in fifth in the nation one-way truck rental, which means people are moving here. The Maricopa County is really, really large. There's going to be 770K jobs in the next decade. So that's about 2.2% annual increase, way outpacing basically the absorption rates in the market, like the new units delivery over here. Again, people has to build. It's not affordable to build affordable homes anymore. Right. It's kind of funny to kind of talk about it, but it's true, because with the supply cost increases, then for the builder to make that difference and still make deal work before they walk away from them, is that they have to go with higher end build with a more luxury feel. And so that they have to sell to people who need to charge more rent. So that kind of snowballs. So nobody is essentially building the inventory that we invest in the B and C classes, which is really the workforce housing, people who are blue collar or people who are just simply looking for value in the housing. That type of inventory is reducing every day. So Phoenix is still having very strong rent growth at a 21%, and the low vacancy continues to stay at a 4%. Depends on what sources that you consult, 4 to 5% over there. Again, the location of this submarket is really, really awesome. We won some Airbnb on our apartments just for product testing. Jonathan had the luck of staying in one of our property called Alto Tez. This is really the best clustered of portfolio the best cluster of buildings in our portfolio. We have a property that we just own called a Demian Fillmore down here near Roosevelt Road. Fantastic location. You can literally walk to the best nightlife in Phoenix there. And then moving upwards, we have 7 minutes driving upwards. We have El Cortez, which is literally near Rise Melrose. So we kind of map this out. There's a 3 minutes drive between Rise Melrose to El Cortez on the 7th Ave. All three property is strategically positioned in a cluster on the 7th Ave, which is a very, very busy street. It was really hard to make a left turns coming out of El Cortez all the time. So this serves us as a scalability management on that. So we know the submarket very well. We have resources over there. We can use scalability of the staff and reduce our payroll cost, be more control of the operation over there. And also one thing to mention on the Melrose is Rise, basically U apartment, we're going to be renaming this property to U apartment, is the fact that it has all the 2-bedroom layouts and they're at 1,000 square feet. Our new acquisition manager was having a hard time finding comps over that because that type of layout is really desirable and it's very, very low inventory for this pocket. There's a lot of studios and 1-bed units. El Cortez is a pretty much all studio building, and it's doing very well currently. And that actually plays a really good tandem between that and the 2-bedroom layouts that Melrose has, because it allows us to offer the same person walking through that door a different option, different types of unit to live in. And then it creates a little bit more diverse, like a versatility between the marketing for these 3 properties. Our median home prices over there is $513K, and the population growth in about 1 mile radius, about 5.1 based on Yardi. That's about compound rate of more than 1%. Median household income is 49K, almost 50K. So this is a pretty solid B minus location for us. Most interesting to note is it is right beside the Melrose district. You saw that gate that I showed in the beginning of the slides there. It's literally the entrance to Melrose, which is this kind of another nightlife, high entertainment area. This building is literally next door to that whole. So make that pretty trendy in terms of attracting the younger crowd over there. So here's a little bit demographic breakdown over here. You do have a lot of the college, bachelor degree, postgrads over here. If you look at the education stats over here, adding together, more than 70% of the population over here has higher education, which is an indication of a good job, right? Indication of the area population. You do have also 5 hospitals around that as well. So great demographics over here. Here's a little bit of a look of this property. It's currently named Rise Melrose. It will be renamed to new apartments at Melrose, thanks due to the seller's requirements. And in fact, we have deep relationships with our seller, so we were able to obtain negotiate a pretty good discount on this property due to that relationship. So we used to be, ex-partners on this. So our property highlights are 96 units. It's individual HVAC water heater. So this is a really great element. So we don't have to deal with our good old chiller system, which we're good to deal with. We have about 100% large 2x1 layouts with washer and dryer. So all the unit has washer and dryers in there. Which this is number one amenity that people ask for when people come try to rent at Al Cortez. So we do not have washer and dryer at Al Cortez currently. So we know this is a very desirable amenity. So also because they're 2x1 layouts, the washer and dryer is much needed in these type of layout. So it's got a B class interior with C class affordability for renovated units. Some are like almost like very nice upgrades in there. Only 5 units are being touched, moved to a premium finish based on the previous operator. But the operator prior to that did a lot of heavy lifting on HVACs, and they did upgrade all the units to a deluxe finish. Unfortunately, they have upgraded units with IKEA cabinets. So whenever they break down, we have to kind of put a brand new box in there. So we did budget for full renovation budgets in our budgets, but it's kind of a case if they're breaking down, then we need to replace them. If they're not, then we'll continue to rinse and repeat. It's got I got some picture later on. It's got some really nice epoxy flooring. Fantastic looking. So the lease trade-offs is huge. I think as we speak, Phoenix market rents are really crazy. They just keep on pushing up and more. So the gap is there for loss to lease trade-outs. Cash flow, the deal will be cash flow from day one with our PM fee structure because we are reducing down to a 2% fee versus a 3% fee, saving 1%. So that kind of reduced a lot of cost over there. We are self-managing. So this is a cost that we can control. And people sometimes will ask, why still charge PM fee? Well, the PM fee pays for the backend structure and system and softwares, and as well as our payroll, regionals, and etc. So I want to kind of just give you a little bit more details on that. So we have assessed it with a 2% PM fee, reduce our asset management 1%. This creates a really balanced structure to make sure our backend staff is supported to make the operation more efficient, software driven, system driven. Low risk business plan in terms of we're focusing on saving costs, lower utility expenses. And just by the way, a standard size and 96 unit, people will be charging you anywhere between 3.5%, 4%. To 4.5%. So just because the unit size is wise, so you're saving about 2%, at least 2 to 2.5% on the property management fee, with being 2% only. So low risk business plan to lower utility expenses, continue interior upgrades, and burning loss to leases. We're not going to do upgrades if we see the market start restrict, but we're going to budget all the budgets for this. And then in this deal, there's no CapEx budgets that the lender gives to us. So we do have to raise the cash reserve. So as a result, we would have $2 million in hand. Either it's going to be spending on reserve or interior upgrades. So that's plenty of room to maneuver, especially with a fixed rate debt, which is a fantastic way to mitigate the market. We will be upgrading remaining units, possibly half of remaining units, adding Wi-Fi in the units. Wi-Fi is a feature, I think, coming with the unit. That's a really good amenity that helps us turn the tenants. We are planning for a 5 to 7 year hold, essentially a long-term hold with a cash out refi strategy. Because we're using Freddie loan, it will continue to be a fixed rate debt unless we decided to refinance it. And we're going to be using this mechanism for called supplemental. Essentially, it's a secondary loan. As you add more value, your valuation increases, then you go into the lender and ask for a secondary piece on this to get some of your money back, or to get some of the money from the lender, which then we plan on distributing to our Class A to essentially lower the Class A share over there, increase the B and C share. Cool. Here's our property exterior picture. So this property is pretty neat and clean. It's got 2 pools over here. It's got a couple courtyards over here. Roofs are in pretty good shape. Not a lot of repair because they just refoamed the whole thing. Basically here are some equipments indoor. There's Amazon lockbox already inside, so tenants are enjoying these features. And then this is a stage, as you can see, some IKEA cabinets over here. So this is a classic unit, but the floor is like epoxy concrete. So this does not look too bad. This is pretty good, as long as the cabinets doesn't break down. So this is like what is most of the finish for the deluxe or the classic unit. So not completely classic. And this is a finished unit with a premium finish, with quartz countertops and the cabinets, etc. I think this is that. Okay, so our business plan, again, eliminating delinquency, burning off lost leases, upgrading additional 47 units for a 150 unit premium, and install Wi-Fi. So by installing Wi-Fi, we're going to get $65 charged back to the tenants, but tenants are paying right now about $80 to $90 a month to their provider with a much slower internet speed. We're going to be installing pure fibers on site. So this is a asset to be added into our balance sheet as well. We're going to implement water conservation program because all the toilets has they haven't done this program at the property. So this is going to allow us to save at least 30% in water saving, maybe even more. And then we're going to reduce our PM fee to 2% PM fee only, and create a much more efficient to reduce the PM fee. So it is going to be an in-house vertically integrated PM execution on that. Okay, let's take a look at the Rencom. In the Rencom section, where we're being very conservative, if you can kind of see our competitions over here, that our unit is the largest in the area by no comparison with others. Yet our rent is the lowest pretty much in the market by rent per square foot over here. Now, in addition, even if we moved it to a performance rent, which is indicated in blue here, the orange ones are the current in place one. We're still going to be below the competition. You can see the actual rent per square footage wise, we're kind of still in the bottom of the pack over here, even after we moved it to a little bit higher rent. So this number is pretty conservative. Now, let's kind of take a look at some of the numbers. Now, just want to reiterate that Class A, we still have 3 classes of investments in this. So Class A investors will be enjoying 11% fixed rate annual return. And this class also shares depreciations, and there's no upside on the equity that being shared. So this class of investor is usually really suitable. People who usually suitable for this class is people who usually needed the basically cash flow on the monthly basis. So like any investment in our PPM, we always indicated that we do not do distribution until the 6th month. And then once that starts, it's going to go quarterly. But that being said, it is our goal to try to distribute to Class A on a monthly frequency. Now, next up is the B and C investor. So this type of investment is going to help you with equity growth. So we have done in such a way that we have gave majority, we actually created a relatively big stack of a Class A in this particular investment, because partially of that equity is invested through by GP through a 1031 exchange. We're going to be bringing about $3 million into this deal of GP's own money. And that is a good base for our investment. Now, Class B and C are pretty similar. The only difference between B and C is that B class investors are bigger investors at 250K minimal and C at 75K. So this class enjoys a 75-25 or 70-30 split. Depends on which class you're in and which minimal that you satisfy. There is going to be a preferred rate. I just want to emphasize for this particular deal, because we have moved so much cash flow to the top of the funnel to Class A, and these 2 classes over here is going to be less than 2/3 of the stack over here. So therefore, the cash flow remaining for these deals is going to be minimal to none until we start cashing out some Class A investors. So the preferred rate over here is really accumulated, likely going to be paid in the back end or when we refinance through a supplemental. The possible depreciation is about 40% onto these deals. Again, this is a word version of what I just kind of mentioned before. The B and C class is really great for people who really want to grow their equity and wanted to receive future cash flow. So this is just a graphic representation what that look like. I'm going to leave it in the slides, and that's going to be available for consumption in the PPM. So as you can see, the first couple years, the return is pretty minimal in cash flow. However, that being said, we did not model in a cash out refi scenario or supplemental scenario, which is basically our primary business goal. So the supplemental can happen in year 1, year 2, and then this is going to, by paying down that big stack of a Class A, this is could potentially significantly increase over the time. And we have kind of seen that type of performance on our other property, Harlow. Okay, here's a summary offer of the fees and sponsor shares. So for this deal, we have set a PM fee of the total 2%, and then we have reduced our asset management fee at a 1% rate. So net sum is still a 3% of the income. And there's going to be a 3% acquisition fee, just like everything else. So I'm going to leave this slides and not going to dive in too much of this. All the details are over here. Again, we have a fixed rate debt, and we budgeted 5.2% at that point. And then the rates could potentially come down a little bit before we close the deal. And the deal will have interest only 5-year period, and the amortization being 30 years, and the term is 10 years. It is going to be a yield maintenance. So the business plan that we have for this deal is we're going to just continue cash out refi until we get people's money out of there, about 80 to 100% for the B and C class, and then for A class to get them cashed out completely. Okay, moving forward, this is our 5-year projection. So a little bit things to note that we're buying this property at 4.3 cap rate, which is a really good price. And then in addition, because there are 2% PM fee versus 3%, this is pretty much the reason why our expenses are so low compared to the current operators. Also, our other incomes has increased from second year, and this is simply to budget in about half of the unit is implementing Wi-Fi strategy, which we know once we get started, that is not limited to only half of these units. As you can kind of see over here with our expenses, our DSCR is really high at 1.76, which means that we will not have issues serving senior debt. And this is really important in times of turbulence now, that basically we don't have to worry about paying mortgage. Just in case people are wondering about what is our stress test, what does that look like? How many people basically, what is the break-even point on mortgage payment? It turns out almost half the unit can basically not pay us or be vacant, and we're still going to be able to sustain the deal. So that's a lot of buffer. And then the break-even point for Class A not to be paid in full is 16% economic vacancy. So this one, when we first started, it's a little bit sliding over there. Not only that, we talked about before, having cash in hand really helps operation and helps with potentially service the loan. Our CapEx over here is basically about $2 million, which is almost 3 years without anyone paying us. Now, we have included a cap rate sensitivity analysis over here, which kind of shows at 4.75, what are we getting in prices? And at 5.5, when we exit, what we get in prices, and these are the returns. So as you can see, multifamily is pretty forgiving. Even on the downside of 5.5, we still made 40% of money. And then there's a lot more upside to it. All right, lastly but not least, there is going to be tax saving to equity investors as well as Class A investors. We're going to be conducting a cost segregation study on this, and then generates the tax saving. It will basically generate the accelerated depreciation, which we will pass down to our investor. We estimate about 40% based on your first year investment. So if you invest 100K, you're likely going to see about -40% of K1 coming your way. So thank you so much for sitting through all these presentation materials. So finally, I always like to end our presentation with going around the roll calling and asking the GP why we like about this deal. So one big thing is the GP are going to roll over $3 million of our own money into this deal, cash into this deal. From the project is that's very similar to this that we have made quite a bit of return on. Probably over 200% profit on. So we are exchanging our own dollars onto this deal. So that's more than 25% of the deal is getting funded by GP cash. So you always ask us, where do we stash our money? This is it. This is available for you to stash your money at too. And I like this deal because it's a fixed rate debt. So we're really leveraging that and using that to arbitrage against the uncertainties. And it's a cash flow from day one. So you can't really get too much of a cash flow deal in this hot market now with a fixed rate debt. So this is a fantastic thing. And it's also a great property. So I like to park my money into that. Jonathan, what would you say one sentence to kind of describe this deal that's your favorite parts of the deal?
Oh, in one sentence. Well, I was just in Phoenix a few days ago, had a chance to visit this area, and it reminds me a lot of the up and coming Capitol Hill that's in Seattle, Washington, that just became a very popular place. It just has that trendy vibe that attracts a lot of demand for the space. So I'm really, really excited about the location. That was a long run-on sentence, but yeah, that's why I like this deal.
Great. And Aaron, why do you like about this deal that we're all both put so much capital in this?
Yeah, I'm definitely 7 figures of that capital going in. I'm really excited about it because I think there's so much uncertainty in the marketplace, whether it's crypto, it's the stock market, people are asking about real estate. I really, really, really like the fixed rate nature of the debt. I think that can't be under mentioned. So I really like the fixed rate and the long-term play with the ability to possibly cash out if things go the way we anticipate. And if not, we'll cash flow while we wait for the markets to return. So I like very much that it's a fixed rate deal. And I think that's fixed rate the cash flows right now in this high inflation environment. I'm super pumped. I'm in.
Good. And then Becky, why do you like about this deal?
Pretty easy business plan to execute, not a lot of CapEx, and exciting to know that the PM will be brought in-house, and hopefully that will, get better control of the properties and execute that business plan.
Absolutely. And then we're able to maintain that low PM fee structure that carried over from our existing PM, and then make a readjustment, actually lower your costs on the asset management side as well, to give a little bit more to our investors. Great. So next set of action is our portal will start to accepting the submissions. By the time you receive this recording, it will be started already. So make sure that don't wait. Please making sure that make your way through the fundings and etc. And the deal will close July 15th. There's an urgency to close the deal. That's why we get a great discount from the seller, because seller needs to exchange this to another deal. So we got quite a bit negotiation rooms over here that we have exercised. We will be buying this deal over 4.2, 4.4 cap rate by the time we close this deal. So this is a phenomenal deal in this particular hot market. Yeah, in the traditional market, cap rates around 4%, even in this turbulence time. It will be first serve, first come, first serve. Our team of staff and investors at Easy Real Estate will be our quarterbacks on this. So you will probably talk to Cassandra, Sarah, or Christina, are great members of account management to help you through the whole process, but making sure you'll wire your fund first to secure your spot. All right. Well, thank you so much for your time today. And we look forward for you to invest with us this time around as well.